I don't think I have that level of commitment or attention span, maybe one of the two.
I mean, everybody thinks it takes a lot of work, but
All right, welcome. Teddy Pins here, and today we've got a hot one. I'm super excited. We've got the famous Loy Carney, who we miss in our halls, but I know you've been busy. And then the Abby Choate, who is my new insurance expert. Not so necessarily new. We've been working together here a bit now, but she's handling all of my insurance with Carlson Insurance Group. This is not a promotion for them. Rather, I want her to have a chance to share some in-depth tips and tricks and considerations really for what you need to and be mindful of with choosing insurance for yourself and for your clients. But we're going to start with the Loy Carney, and I'm going to turn it over to you, Loy, to help us become better experts in being ready for closing and what we're reading and doing and all that jazz. So thank you for being here, Loy and Abby.
Okay, good deal. Good deal. Well, as you've just heard, my name is Loy Carney. I'm with Rudy Title and Escrow. Many of you already know me, hopefully from the closing table, but if not, I look forward to seeing you there soon. And I'm so excited to be presenting today with Abby. Abby, I am going to try my best to be considerate to you and your time, because as Ted and many of the folks here know, that I am a lawyer, and the lawyer's motto is, why use 10 words when 100 will do, right? So I'm going to try my best to be brief and succinct today. And to kick that off, I want to kind of talk about what's on the screen right there is some guideposts for what we're going to look at. And then I have a preamble that I want to get into before we dive into the presentation. So the closing process is really broken up for clients into three parts that we need to have a little bit of understanding for. The loan estimate that comes out to the clients ahead of time from the lender. Then you have the closing disclosure that arrives about 3 days before closing to the client. And then you have the ALTA statement that they most of the time see for the first time when they get to the closing table. Okay, so we're going to go through those. The loan estimate, we won't spend much time on at all, but I have kind of some detail in the presentation. And by the way, every bit of this 10-page presentation that you see, you're going to get that after the fact. I'm going to email that to Teddy and he can make it available to everyone, because I think there's going to be some drill down pieces that you'll want to read a couple of times in there that we'll just kind of gloss over for the sake of time. So that's the presentation that you see on your screen. But to the preamble that I talked about, I've just got some bullet points that I want you guys to think about, especially if you are in your first year as a realtor and you're still warming up to the closing process. I am not numb to the idea that closing can be very daunting. It's the crescendo. It is the finish line. It should be treated like a celebration, but because there is so much tension surrounding that day with people having things on moving trucks, I know that it can be really daunting for people. So here's some tips to think about, okay? So setting expectations for the financials. Usually after a realtor gets into their gig for about, I don't know, a year to 2 years, they pick up on the idea that there are some clients out there that feel like they should be able to review their financials that they will sign at the closing table 30 days before closing, okay? And some people are a little more reasonable about it. They only want to see those 3 weeks before closing. Some people are even more reasonable, and so on down the line. But as we know, who have been to the closing table and done many closings, though a lot of times those financials are coming out to the borrower via the CD form about 3 days before closing. Now that's a federal regulatory requirement. If we were in a live classroom, I would ask the question, can those numbers change from the 3-day preliminary closing disclosure until they get the final closing disclosure at the table? And because every face that I see looks brilliant today, I know you would all answer, yes, Loy, they can change, but only up to 1/8 of 1 APR percentage point on the loan, okay? Now there's some other reasons why, but that is the main one that we deal with. So if you ever see changes, that's going to be the main guideline. So the way I phrase that to clients to help them digest it is, yes, there can be some minor changes, but there can't be any major or significant changes that affect the APR rate in a significant way. Okay, does that make sense? So just make sure that as you guys are getting your clients under contract, especially on the buyer's side, but even on the seller side, let them know that they will not receive any reliable financials until about 3 days before closing at the earliest. Okay, does that make sense? Okay, so point number 2 is what to bring. As you're going through your checklist of things, and by the way, Teddy is great. If you ever want to figure out somebody who has really honed this thing to a science, pull him aside, take him to lunch, because he will share with you a lot of his mistakes, frankly, over the years, and how he, at every step along the way, has a new basket of information for clients. And so if that's interesting for you, I highly encourage you to pick his brain because it is worth that lunch. But what to bring? ID for sure, and that's the easy one to remember. But I don't care if you represent a buyer or a seller. It is a good idea to have your client bring a checkbook. Now that's going to be challenging for younger clients. I won't say millennials anymore because I think we even have some people younger than millennials coming closing. But some of them don't even have a checkbook. But on the buyer's side, numbers may change just a little bit before closing, and that cashier's check that they brought or the wire that they sent won't cover that last minute power of attorney that they needed to have recorded for $12 or something like that. So have them bring that checkbook to closing just to cover any of those whoops expenses that would otherwise torpedo the deal or make them come back later with a check. Okay.
No cryptocurrency or credit cards yet?
No cryptocurrency or credit cards. And sadly, that's because of the good funds legislation, which is a subject of a whole other class. But just suffice it to say that all closing funds must be delivered by federal wire transfer, cashier's check, and only those minor fees can be delivered by a personal check. Okay, so what to bring? ID and checkbook. Number 3 is review the settlement statement. When that comes out to you, the processor at your title agency, hopefully that's Rudy Title, is going to send you a copy of the settlement statement. Review it, look at it. Especially, I mean, don't be that realtor that looks at commissions first or only looks at commissions. You definitely want to protect your client, but make sure commissions is one of the things that you review. Because I will tell you that the number 1 revision that we have to settlement statements at the closing table is because we have 6% commissions on the settlement statement, and the listing agent has negotiated for something different. Now, the reason we don't know that is because commissions are never in the contract, which we receive. So there has to be another level of communication to get that information over the title agency to let them know what your commissions are. And don't forget, if you have a base commission fee, that needs to be included in that conversation too, because it is oh so awkward. It's a little bit easier to reduce your commissions at the closing table, but it's a little bit more awkward to be sitting at the closing table and say, whoops, I've got to stick it to you for another $295 because I forgot to tell you about my base commission fee. Okay. So just check those things, and, just do the broad strokes too. Make sure that the correct numbers in there for your expectation for the seller to pay closing costs on behalf of the buyer. That's another big item that usually requires some scrutiny. Number 4 is walkthroughs and escrows. After a realtor gets in the business about a year, they discover this little magic trick called escrows. And once they discover it, a lot of agents, well, not a lot of them, a few of them want to pull it out pretty much on every walkthrough. And just know that escrows you use those like gold dust. You use those for the major things, okay? If you walk into a home and you see that on move out, they scuffed a little paint, that kind of stuff is going to happen. If you see that they gouged a wall and knocked out some wallboard, then maybe that's something you negotiate with the listing agent and figure out how that's going to be compensated. But for the major things that are going to cost more than $1,000 usually, that's where you want to think about an escrow. And you also, before you do the escrow, you want to check with your borrower's lender to make sure that they will allow for an escrow on the settlement statement, because about half of them will not, because lenders do not want a loan on a broken house. They want a home to at least on the paperwork be represented as a good home. Okay. Number 5 is negotiations. Remember that as you get to the closing table, as the realtor, and remember I'm a realtor too, so I wear this hat too. Realtors are responsible for the negotiations. So if you come to the closing table and there's one other little piece that is going back and forth, please don't look to the closing agent to deal with the other title agent and play a telephone game that's about 4 layers thick to circumnavigate the negotiation that all realtors should be handling in the transaction. Just remember that all the way until this thing is closed, that realtors are responsible for the negotiations piece. Okay. Now, once you decide on those terms, in terms of getting things swapped or transferred or to give effect to the contract or any amendments that you've drafted, that's the settlement agent's job, and they should be doing that. And then last, as a preliminary matter, is just where to sit. When you get to the closing table, remember that sometimes when you, thinking pre-COVID days, when you can come into the closing room, a lot of times an agent will sit down directly across the table from their client. And that may work out until the title agent gets there. But almost every title agent I know, they do a much better job if they're sitting directly across from the client, okay? If you have 2 clients or 3 clients, try to get them to sit on the same side of the table. If they sit on opposite sides of the table from each other, and I present a document to one of them, it's going to be upside down to the other, okay? So that'll just be a little helpful when you get into the closing room. Let everybody settle in the seat that they're going to be in, so that there won't be a fruit basket turnover once the closing agent gets in the room and has to redistribute everybody in order to do this well. I always feel like it's amazing. You know, usually in closing rooms, you have a rectangular table. I think it's perfect for the realtor to sit at the head of the table. You can see everything, you can reach everything. And if I say anything wrong during closing, you can probably kick me under the table too. Teddy's done it before and it works. I get the communication and I just, I change my tune real quick. So those are my tips on pre-closing, getting to the closing table and sitting down and looking at documents. So like I promised you, we're going to get into the presentation. Loan estimate, we're just going to glance over that one really quick as soon as I get my presentation to work. Teddy, hey, can you see my mouse right there?
I can, yes, sir.
Okay, good. This is my first time playing around with the highlight the mouse feature. So I think it's a little bit easier than talking about where I'm trying to look at on the screen. So you'll see here in the loan estimate, remember this is going to go out several days before closing and give the clients an expectation of what they can expect at the closing. Now, the format that they use here, and really our only takeaway that I want to go over today, is the format looks remarkably like the closing disclosure that we're going to look at in just a moment.
Could you zoom in? Could you zoom in one click on that? On just so we get that.
Is that better?
Boom. Can everyone see that? Okay. Is that better?
Yeah. That's a great idea.
Perfect, Lloyd. Hey, this is spectacular already. You've already earned your
earned my keep.
Snickers bar. Yeah. This is amazing.
I'm going to hold you to that Snickers bar too.
Hey, and listen too, feel free, if we have to go a little over today, I'm okay with that. So, because this is really important. And so don't worry about cutting it short for Abby. If I have to put Abby on another class, we'll do that too. It's like the Letterman show. You know, you get bumped, you coming back for the stupid pet tricks.
Oh, heck no. I'm not bumping Abby. No way. She's smarter than me and cuter than me. I can tell already. So, all right. So, loan estimate here, there's a lot of detail that you're going to be able to go through and do a little self-tutorial on the loan estimate. Now, the thing of it is, you as the realtor, I as the title agent, we don't see the loan estimate. This is a document that is purely between the lender and your client, okay? But I want you to know the detail of what they're going to see just so you can help them translate it, because you will run into a client on occasion that will forward it to you and ask for you to try to help unpack this thing. But we're going to learn a lot more about this when we get to the closing disclosure, because a lot of the mechanics are exactly the same, okay? So with that in mind, let's flip over to my favorite part, which is closing disclosure right there. Okay, see if I can blow this up just a little bit. Luckily, I've got a touch screen, so that's helping me out over here. So in section 1, actually, let me go down here so we can see some of the, boom, there. So we can see some of this narrative over here on the right-hand side of the screen. So section 1, of course, is going to be the date that it is mailed or delivered to the borrower. Remember, I told you that it's a regulation that it has to be delivered to the client 3 days before closing. And so that's going to be that hopefully, for the lender's sake, reflected in that date issued versus the closing date, which is going to be on number 2. Now, we call it closing date. The form calls it closing date, but occasionally you'll hear a regulator call it a consummation date. Now, that sounds wildly formal, but that's the term that they use in the TILA-RESPA final rule regulations. So it's the consummation date is the same as the closing date, okay? Here, names and addresses for both are required. That's going to be the borrower and the seller right here. Sometimes sellers' addresses can be a little wacky. Normally, we just use the property address for the seller instead of a forwarding address because sellers don't really want borrowers to know where they're going to be living in the future. So that's what you can probably expect to see on most every closing disclosure. Of course, you have the transaction type, and that speaks for itself. Purchase or construction is going to be about the only ones you see on a purchase transaction, although we see refinances and home equity loans on the title side pretty often. Number 5 is the loan amount, and that's truncated. So if there are any cents that are being loaned, those are just cut off after the decimal point. Item 6, this is really important because you can see if yes on item 6 right here, can this amount increase after closing? In other words, what is it saying is, can the loan amount increase after closing? Well, if the loan amount is going up, that means it's a negative amortization feature. Now, if they are paying down this loan as its traditional mortgage, it's going to say no. And also, if it's an interest-only loan, the loan won't be going up. It'll only be staying the same. So that's also going to be no if it's an interest-only loan, okay? So you will probably always see no on this line because a negative amortization feature has become wildly exotic in our post-2008 closings. Of course, you've got the interest rate down here, very important, and it's a very exciting thing to celebrate right now while interest rates are phenomenally low. I did a presentation yesterday with our FNB partners, Connie and Roger, and I think interest rates are at about 2.5% right now, maybe one tick up from that, but I mean, just unbelievably low. So definitely celebrate that with your clients when you can.
Quick question, Loy. Again, just for everyone, this closing disclosure does not go to the realtor. This is just for the borrower.
Well, you know what? I feel like I have staged you in asking that question because look what I've got down here.
I was going to say. But the other thing, before you jump there, this date issued and closing date, this 3-day prior, I'm seeing some instances where they're saying they don't have to. We've gotten around that. What creates that scenario? Do you know?
There are, if they can show good cause, the lender can get around that rule. But honestly, that's something that's it's the lender's responsibility and it's their punishment if they get called on the carpet by a regulator.
Makes sense.
So I just leave that completely in their ballpark. But that's why I say for most all transactions, and historically it's about 90% for me, they're disclosed about 3 days ahead of time.
Agreed. I just want people to be aware. I've seen where lenders are like, no, we don't need to do that, or what we can. And I'm like, wait. I thought that was like a hard, fast rule. And it really is or should be. I mean, the buyers, all parties really deserve that notice as well to review the documents. That was part of the intent and spirit.
And Teddy, you and I know, and everybody who's been in the business since before 2015, back in the days of HUD, those didn't come out 3 days ahead of time. So things are much more comfortable now than they used to be. You used to
3 hours, 3 minutes.
Yeah, maybe a day ahead of time. That was it. And that was, you felt like you were on cloud 9 when you got them a day ahead of time. But now, because of this regulation, it's been helpful. And clients are, buyers especially, that want to review these numbers and have a lot of work to do to understand it. They get it 3 days ahead of time. Yeah, thanks for that. But to your other question about the closing disclosure and who gets to see it, By default practice, the realtors do not get to see the closing disclosure to a transaction. However, the clients can waive that right of privacy with the closing disclosure, deliver that information that they've waived that right to the title agent, and then the title agent can share it and the lender can share it at that point. So what Village has done to take care of everybody that's in this class is, you're probably familiar with the trusted service provider form here that's necessary for compliance on every transaction, okay? But if you'll go to the bottom down here, there's a couple of key parts that aren't really part of the title of that document. Number one is the wire fraud disclosure. That's very important. And I would encourage everybody to go over that in detail with your clients at the beginning of a transaction. So if you are putting together your agency package for a buyer or seller, this form should be in that agency package before you ever have an offer on the table, and go over the wire fraud disclosure at that time, just so they know it on the very front end, and put the fear of God in them so they do some careful stepping when it comes to sending wires. And then, but the part that's important to this conversation is the closing disclosure waiver. And that says that you, as the realtor, get to see a copy of the closing disclosure if you'd like. And any title agent in town should look at this document and say, okay, yeah, you get to see the closing disclosure if you'd like to. Okay. So thanks for asking that question, Teddy. You know what? I'm going to say one other thing before I jump back into the nuts and bolts here. What's the best way to say this? At the time of closing, the client is going to get the closing disclosure 3 days ahead of time. The realtor, without more, is going to receive the ALTA settlement statement that's prepared by the title agent, not the lender, but the title agent, about 1 day before closing. Okay, so that means your client is looking at the closing disclosure, you're looking at the ALTA, and together you're trying to reconcile the same numbers, but presented in different formats. And that gets kind of confusing. So that's might be some of the rationale why you want to try to get your hands on a closing disclosure whenever you can. And you can always reach out to the borrower's lender to get a copy of that with that form if that's something you're interested in. As you get better with it, though, you'll be able to look at the ALTA and discuss the numbers on the closing disclosure. So you'll get a little more adept to it, but especially while you're warming up to the process of getting comfortable with all these numbers, comparing apples to apples with your client could be really helpful. Okay, so that's kind of the two forms. Oh, one other thing, with the closing disclosure versus the ALTA, remember who they're prepared by. Closing disclosure is prepared by the lender, ALTA is prepared by the title agent, and both companies are required to match those numbers penny for penny. If they don't match, we're not in compliance. Okay. So once those things have matched up penny for penny, then we're good to close. And that's when we get our final clear to close from the lender. So just know that that matching process is going to happen too. Okay, so let's jump back in on the closing disclosure. Down here in projected payments, whenever I discuss this, I always go down here to the very bottom first, because that's the number a buyer wants to see. What is my total monthly payment? So I tell them the end of the story, and then I tell them everything that makes up that total monthly payment. Now, under this payment calculation here, you can see this one's easy because it just has year 1 through 30 together. There are two common scenarios where you're going to see that broken out. One is if your client has an adjustable rate loan. If they have an adjustable rate loan, there could be up to 4 columns here that will describe those 4 different escalations of rate, or de-escalations if rates go down. But you'll see those kind of building up across the page. And it always shows best and worst case scenario on the interest rate adjustments. So that'll be max and min is what it'll say there. Okay. And the other case, which is more frequent, where you'll see different scenarios going on here, is where there is mortgage insurance in a conventional insured loan, and that mortgage insurance goes away after a number of years. And so you'll see in the first column, mortgage insurance as part of the payment. And then in the second column, you'll see a lower payment here at the bottom because the mortgage insurance has gone away. Okay. Now it's the subject of a whole other longer discussion about mortgage insurance, but just suffice it to say that it automatically goes away once the loan gets down to 78% of loan to value. 78% of loan to value, conventional mortgage insurance goes away. Not FHA, only conventional insured. Okay? And then down here on item number 10 here, always be aware that homeowners insurance is not part of the mortgage payment. It is never part of the mortgage payment. If we were in a live class, I would ask, what is it part of? And because you're all bright and attractive people, you would all answer in unison that it is part of the lender's housing cost calculation. So if you are going into a condo and there's a $4,000 a month homeowners association dues there, that's going to reduce the amount of monthly mortgage payment your client can make by $4,000 because that's part of their housing payment, and that's got to fit into their ratios. But when it comes time to actually paying it, it is always paid outside of the mortgage payment, just like a utility would be. Okay? Down here at the bottom, 11 closing costs. These are very important ones, but they're self-explanatory. Closing costs is everything that's consolidated from page 2. So this is just a total, and we'll spend some time on page 2 unpacking that number. And then cash to close is the bottom line number that your client needs to wire or bring in by cashier's check. So that's the magic number that they need to be packing with them when they come to closing. A couple of points about this is some new buyers, maybe even some buyers that's not their first home, they just haven't done it a while. They feel like they need to bring in their cash to close because that's their down payment. And then they also need to bring in their closing costs in addition. So make sure you prep your clients and let them know that the only thing they have to bring in is the cash to close. That's it. That's after we've taken all of the costs and put it on one side of the scale, taken all their credits and put it on the other side of the scale, and then they're just bringing the difference here. Their closing costs are just one of the costs that's on the other side of the scale before we get to that bottom line number. Okay, so let's get over to page 2. If I can make my screen work here. There we go. And minimize that a little bit. Okay, so closing cost detail here. You can see here that in this section, by the way, everything is alphabetized in each one of these minor sections here, okay? Now they say except for this A1 here is not alphabetized, but I think it still is because it has a symbol in front of it, and symbols are always alphabetized before letters, so we can call it alphabetical. The first section here is generally all of the bank fees, okay? The second section is going to be the fees that the bank collects but makes payable to the necessary third parties to complete the transaction. And then the third section down here is the title section. And in this section, you will typically see the settlement fee and the lender's policy fee. Those are the two items that are there. Now, more often in Tennessee, actually Middle Tennessee, when it is not a new construction, the seller will pay for the title insurance expense. So we'll see that over here. And that's why these vertical columns are really helpful too, because not only does it tell you what the seller's going to pay versus what the borrower's going to pay, but it'll also tell you inside of each field what was paid at closing versus what was paid before. And we know that in our market, the appraisal fee right here is the one that we always will most often see the lender wanting that paid in advance. Because once that appraisal is performed, the money is earned by the appraiser, whether the closing happens or not. So a lot of times they'll like to move those over here, or at the very least get a credit card on file for your client in case the transaction doesn't close, they can charge that credit card. So one note that I know Teddy and I have dealt with at the closing table, and he always does it very adeptly, we'll see the appraisal fee charged at closing, and the client will say, wait a minute, I gave my credit card to the mortgage lender, I paid that in advance. Well, you got to go, your client has to take one extra step and make sure they were actually charged that, because sometimes the lender only gets that credit card to secure the funds in case it doesn't close, but they never actually charge that to the client. So just make sure that if your client has that worry, that they take that extra step and make sure that it was actually charged to the credit card or debit card that they gave the mortgage lender. Okay. So in this section right here, we total up this column, both the at closing and before closing. And that's what we see on the buyer's side right here. Okay. For the totals. And that's the loan cost subtotal. Then we get down here to the, oh, one other thing, section 4 over here is going to be any fee that's paid for by others. Typically, the only thing that you're going to see in this column right here is something paid outside of closing by the lender. And we'll see the amount they paid, and you'll usually see an L in parentheses beside it to say that the lender has paid it. Okay? So down here in other costs, we kind of do the same operation, except we have different categories. This one is the recording fee and the transfer taxes. Remember, all transfer taxes in Tennessee are due at the time of recording. So you cannot record the transaction and put it in a new buyer's name unless that transfer tax is paid. In Tennessee, not only do we have transfer tax on the deed, but we also have transfer tax on the mortgage. So sometimes you'll see 2 lines down here for transfer taxes. One's going to be for the deed and the other's going to be the mortgage tax. Okay. And then we have prepaids. And there's usually 2 items that we prepay in Tennessee in this market before October, 3 fees that we prepay after October. So since we're after October, let's just talk about all 3. Number 1 is the homeowner's insurance premium. You'll see that prepaid for a full year. That's always prepaid to the insurance provider that your client selected before closing. And that lender has already been vetted by the mortgage lender, so everything is copacetic there. But that's the first full year. Then we have our interest that's prepaid. That's interest through the end of the current month. Now, I want you guys to get good at, or at least better at, more comfortable with figuring out when the first payment is due when you look at the prepaid interest here. So you remember, if you're in any current month, remember that your client's always going to get a free month. Okay. So we're in December now, and our client has paid all the interest through the end of December. Okay. So that means that the first payment is due when? And again, because you're all brilliant and beautiful people, I know you simultaneously said February 1st, February 1st. And that's because they paid the interest through the end of December. And because you always get that free month, that's going to be January, the first payment is going to be February 1st. Now, if your client asks you, why is that? That's not very intuitive. And you're right, it is counterintuitive, but it is because you always pay your mortgage in arrears. And that's unlike rent that you pay in advance. If you're paying me as a landlord, you're going to pay me for January's occupancy on January 1st. But if you're paying me as a mortgage lender, you're going to pay me my interest due for January on February 1st. So that's the reason you get that free month. So don't forget to calculate that free month in there if you're trying to figure out when the client's first payment's going to be due. Okay. So initial escrow payment at closing, this is an easy one. That's where we just set up some seed money in the escrow account. That total there on line G is the total amount that's going to be in the escrow account at the time of closing. And the reason we put that much in there is to make sure that the escrow account starts off at a high enough trajectory that it's on a high enough level that it's on a proper savings trajectory to have enough money in that account when the bills become due. And then down here in the other section, this is kind of where we back clean up and just get everything else that doesn't fit in one of the other categories. So typically you'll see a home warranty here. You'll see real estate commissions. Hopefully, if you represent a buyer, you've made sure that all those go over to the seller's side right there. And we're going to see any termite fees, septic inspections. If there's a home inspection that's charged at closing, usually those are paid in advance, but that would appear down here too. So any of those weird little fees, base commission fee is also going to appear down here.
Outsourced contract to close.
Yeah, that's right. If you pass along contract to close to your client, you can put that down here. And I've seen that happen a number of ways. Some people say, hey, that's just my base commission fee, and that's what that goes for. I just make it exactly mirror the contract to close. But that can go down there as well. Yeah, good point, Teddy. And remember that owner's title insurance is going to be down here as well. And I could teach a whole other class on owner's title insurance, but just know that this sometimes can be a negative number if the seller has provided their prior policy so that there's a reissue credit, okay? Remember that it's most likely going to be over here in the seller's column, but that can sometimes be a negative number if the seller's getting a reissue credit, okay? So now we're just totaling it up again. We go down here to the very bottom and we have our other costs down here, subtotal. And then we take our two subtotals, and I'm just going to look at the broad figures up here. This subtotal plus this subtotal gets us to the grand total down here at the bottom. And that's the grand total before we consider what was paid in advance, leaving the closing costs that are going to be due at closing. And that also doesn't consider any lender credits that the lender may provide in this section right here. Now, a couple notes about lender credits. Sometimes you'll see, and I'm going to go back up here to the top for a second so that we can see that in this case, we have a pretty hefty origination fee. You are never going to get that high of an origination fee that I'm aware of out of Connie and Roger at F&B. But let's say, for instance, this lender wanted to give a loan credit for $5,300 to give that origination fee back to their client. Well, this right here is where you'd see that $5,300. More often than not, the lender needs to cure a variance in this section. And what that means is when they present their loan estimate, they have locked in regulatory expectations with the borrower. And some fees can change by a little bit, and we call that the variance or the tolerance amount. And if they go outside that change tolerance, then that becomes a violation under the federal regulation. And one way for them to cure that violation is to just give the borrower the money right here on this section. So sometimes you'll see weird little credits down here for a nickel or $1. They're not trying to change the borrower's life here or win them over for the rest of their life with that nickel. They're just trying to cure that variance that they're firmly held to by the federal regulators to make sure that there's no violations of the expectations that they set in the loan estimate. Does that sound good so far? Okay, so let's get to the next page, and that's where the numbers really come together. On the next page, this section up here compares the loan estimate to the final and describes if those changed and how they changed. So sometimes this section right here will help you explain why the lender is giving a lender credit. And it also, it will help remind your client if they don't have a perfect recollection of what the lender promised them early. You know, if you get to the closing table or the pre-review of the CD and they start saying, oh, wait a minute, this isn't what the lender promised. Well, you can just go to this section right here and say, whoa, this is what they're saying they promised, and kind of reconcile what your client's remembering in their head. But down here is where we always spend the time at the closing table. And this is where a borrower's transaction is really going to come together. This is where a seller's transaction is really going to come together. But beware that in most Middle Tennessee transactions, this side won't appear here on a CD. The seller is going to sign their own CD. And to look at the borrower and the seller's number beside each other, you've got to go to the Alta settlement statement that we'll go over in just a second. Okay. So wrapping up this document here, we can see up here, this is the total. Remember, I told you that at the end of this transaction, we deal with sides of a scale. You have costs on one side, you have credits on the other side, and we just figure out how much money is left over after all the credits are applied to the costs. And that's what a borrower brings. Well, this is the sides of the scale. This is the cost section up here. And conceptually, this is the credit section down here. Okay. So in this case, all of our costs equal the $695,000 figure at the top. And that's made up of the sale price and the closing costs that we brought over from page 2. Now for extra credit, I'm going to ask you, do we bring over all the closing costs or just the closing costs that the buyer is paying on the closing day? And I know that you guys all answered in unison that we're bringing over only the closing costs that they're paying on the closing day, because we do not want to double charge them for an appraisal fee that they paid in advance, for instance. Down here in the credit side, we can see the total of credits right up here. It's a little bit awkward and counterintuitive that the total is at the top and then the details underneath. but you just kind of have to switch your mind and get used to that way of thinking. Earnest money is always going to be right up here. So you want to make sure that the earnest money is correct with your expectations and the expectation that your contract laid out. Beware, though, that if your lender was not able to source that earnest money, in other words, they were not able to go back and look at your client's bank statements and see where that money was pulled out and the money was earned before it was pulled out, then they won't be able to use the earnest money here, and that earnest money will have to be refunded to your client after closing. And again, we call that sourcing the earnest money, and that's something that happens purely on the lender's side. Okay. Loan amount's easy. That's where we just apply the loan amount to the to offset the cost that the borrower has to bring to the table. Here, there's also a title premium adjustment. Just know that right here, this is in this zone right here is where you're going to see if the seller is paying for any closing costs and prepaids. You're going to see it listed right here, and that's probably going to be, you'll see that far more often than title premium adjustment. And down here at the very bottom, we're going to see prorations for property taxes. Okay, prorations for property taxes. So you won't see that after October, though, because like we touched on before, all of the property taxes after October, when the bill comes out, they're due and payable now. So that means that they have to be settled in full by getting the seller's side from the seller before closing, and you get the buyer's side from the buyer after closing. And that's usually going to be written in this section right here as a charge after October. But anytime you close from January through October, we've got to charge the seller and give this credit to the buyer, because before October, the buyer is buying it subject to the property tax bill that comes out in October. And all that means, it's just a fancy way of saying that the buyer is buying it with the knowledge that they have to pay for all the property taxes for that whole year. So that means the seller owes them a credit for the seller's portion. Okay. Now, taking that one layer deeper, and that's as far as I'm going to go with it, I'll just remind you that buyers sometimes get worried about this. How am I going to pay for that? Well, remember, in most cases, that's going to be an escrowed item. And that's one of the reasons back here on page 2, we escrow the seed money right here to make sure that when that property tax bill becomes due in October, usually paid out of escrow in December, that there's enough money in there to make that payment. Okay. So now we've talked about both sides of the scale. You've got your costs on one side, you've got your credits on the other side, and then the final operation is just figuring out what the difference is between the two. Most often, that means that the borrower is going to have to bring this amount of money here. So you're going to see that from box checked. But it's very important to notice when that to box is checked. Sometimes your borrower will have received gift funds. Sometimes they will have arranged for a unusual but not rare 100% loan where they get their earnest money back or something like that. So just be aware that sometimes and not frequently, you'll see the to box checked and they'll get money back at closing. Okay. So that's the CD right there. And I want to flip over really quick, and then we're going to go over some of the key points of the ALTA settlement statement. Again, there's other pieces in here that are really instructive for you guys to read on your own. I just want you to see those and know that they're there, but we're not going to dwell on them today. But here's the ALTA settlement statement. In most every transaction, this is going to be your only time to really look at the buyer's side of the transaction and compare it to the seller's side of the transaction and see what the other side, how they fared in the transaction. If you're representing the buyer and you've got a seller that's been poor mouthing you the whole transaction, and then they're walking with $250,000, then you might think that you got played a little bit, but this is going to be your first time to really figure that out. So we can see here that the sale price is charged to the buyer as a cost, debits mean cost, but it's credited to the seller because the seller is getting paid for that sale price. So always use the sale price to remember which one is good news for the seller, and which side is bad news or cost, and it's bad news or cost for the buyer. And that'll help tune you in for the rest of the columns all the way down, okay? So we can see here on the seller side, we've got county taxes, And the county taxes in this case are going to be debited, or it's a cost item to the seller. So we've charged them through the date of closing, which on this statement is 10/2. Okay, so we've charged them for their portion. Now over here, we've given that to the buyer as a credit. So we see all the credits over here. Okay. After October, the way this is going to change is you'll see it in any event, we've got to charge the seller over here. But if you see a charge to the buyer as well, that means we're collecting the pro rata share from each party, and then we're going to pay that over to the trustee for the whole tax bill. So after October, you'll see a charge over here to the buyer for their pro rata portion. And then you'll see a lot of the same fees that we saw on page 2 of the settlement statement. I'm not going to unpack those again for you here because it'd be very repetitive. But notice down here, title insurance is a little more descriptive on the Alta settlement statement than it is the CD. So just remember that you can go to the Alta settlement statement. That's going to give you a little more education about how the breakdown of the title insurance charges than what you're going to get on the CD that is in the little inset over here. Okay. And then over here on page 2, we see a continuation of the charges to the buyer, and you can see the recording fees right here. And of course that match up with the recording fees that we saw in the closing disclosure. And then on the seller side, we see a list of all their costs over here, including any transfer taxes that usually the buyer is going to pay. Principal balance, the mortgage payoff is always a big one. Commissions are always a big chunky one for the seller, at least hopefully for your sakes. That's always a big chunky one. And that's really about it. Other than that, we just total these things up. So remember your columns when you're totaling up over here. Remember that credits are good news, debits are costs. So these are all the seller costs. These are all the good news, or the credits for that seller. And then the difference between that is going to be on this next line, which says due to seller. Okay. Now over here, the buyer has balanced out. There would be another line in here that says due to seller or paid from borrower, and the borrower would be bringing money here. But in this case, they've managed to fix the loan amount to be the exact amount that they need so that they don't have to bring anything to closing. And so the totals down here at the bottom, don't let those fool you. If you've ever had accounting 201 in college, or probably a high school level accounting course, we'll go over this too. Or if you just YouTube accounting and just talk about a T account, you'll see that when you have an entry in a general ledger, you have to get down to the very bottom, and they have to total up both columns to make sure that they equal each other. Okay, so that means that once you take all of the costs and the proceeds for the seller, that's going to exactly equal all of the credits. And it does right down here at the bottom. It just makes sure that they're mathematically congruent with each other. But this is going to be the number that's the most important for the seller. That's going to be their walkaway number, the proceeds. And when I do a seller side transaction, I always start with this number. And then, of course, a very important number to the buyer is going to be how much they have to bring, which is going to be over in this section. Oh, I'm sorry, right there in that section. I pointed to the wrong cell. Sorry about that. It's going to be in that section right there. So that's really it for the CD. Let's talk about signatures. One last point, and then I'll pitch it over to Abby so she can jump in. Every lender that I know wants the CD to be signed, okay? But it is only acknowledging it, okay? It says here that the lender may not require signature, and that is absolutely true under the regulation. But practically speaking, every lender that I've ever worked with wants this CD signed, and if they don't, it's going to fail as to their in-house underwriting requirements, but not the federal regulations, okay? So CDs must be signed, practically speaking. And then Altas must be signed also. We require those, and every title agent in town requires those, because remember, the Alta is going to be the form that we use on the realtor side as documentation of the closing. And I tell clients at the closing table, the only reason that we have this form here is to satisfy the regulatory requirements that our realtors and brokers keep a record of the transaction after closing. Okay. Now that's the G level approach, but I'm going to give you guys the advanced course too. And there's another reason why we have the ALTA that we don't talk about with clients because it would make their heads explode. The other reason we have it is so that the lender can verify that the closing company who's going to print all the checks, that their math exactly matches with the closing disclosure that the lender has created. Okay. So just remember that there's that sneaky second purpose that we don't really talk about with clients to keep from their heads from exploding. So guys, that's really about it for me. If you have any questions for me, type those in the chat box, and I'm going to pitch it over to Abby and let her talk a little bit. And I'm going to review some of those questions you might have, and we can clean those up at the end.
Sounds great. Awesome. We'll come back to you, Loy. Abby, we're turning it over to you as the insurance side of things. What do we need to know and be mindful to?
All right. Thank you, Loy. That was incredible. It definitely made me realize how much I glazed over on my own closing on all that, and I just learned so much. Teddy, thanks for having me. This is really great.
Glad you're here.
Yeah, I've been an independent insurance agent for about 7 years now. Born and raised in Nashville. Always represented an independent agency. So that means that I can shop several carriers rather than being tied to one specifically. I think it gives me the biggest net to get the best rates for people that come to me. So I've always appreciated that option. I'm going to start with some just broader concepts for why insurance is important, how realtors tie in so heavily to that. And then I'll go into some specifics about what the actual policies entail. First thing, I'm curious how involved y'all are in the realtor process with recommending an insurance agent to your buyers. That can be so crucial. It really helps show that you guys are experts in your field. It's the same way that you guys have a list of title companies that you use, or home inspectors, home warranty companies. It's just something to add to your arsenal. So my biggest charge is really for y'all to go out and meet some agents, find someone that really fits your personality, fits your sales type, that you trust and that you enjoy working with. I know that this job is so much more fun because of the team of people that I have that I work with. So really challenge y'all to do that. It makes you seem like an expert in your field because you're introducing this idea early on to your buyer. You're saying, hey, remember that you guys need to go get your insurance set up. And your lenders will appreciate you so much for introducing that idea early on. If you talk to your lenders, one of the things that they're going to tell you is that insurance can be a big hang-up in the closing process. They are trying to hunt down proof of insurance, declarations pages, and everything from their buyers. And a big way to help them is by introducing that thought early on to your buyer. The more the buyer hears it, the more important it seems, and the more helpful and smooth the whole process is. So on that note, go out, meet with some agents. I would love to meet y'all, but there are incredible agents in Nashville. And just find one that fits you the best. Couldn't recommend it more. It's also going to be a good test of what a good agent is, how quickly they get their lender the documents that the lender needs. A lender that has a good agent that sends them everything they need quickly will just praise you. It's like herding cats and dogs, and you're helping that along by facilitating them and giving them an option that's reliable. Okay, so some details about the policies. Something I always say is that home insurance policies are not created equal. They are not. Every carrier is different. Every agency is different. Every agent is different. They are not created equal. So what I've done is I have my main pillars of coverage that are my go-tos. And then after years of experience, I've learned how to fine tune those to each specific client. So it all starts with, let's see, like 6 main points. And if y'all want to jot these down, these are what I'll touch on. So I don't have a PowerPoint like Loy. I messed up.
You're all good. Just hit it. You're good. We got it.
First thing to write down, we'll touch on is replacement cost estimate. Next thing is extended dwelling coverage. Third thing is liability. Fourth is deductibles. Fifth is replacement cost versus actual cash value. And the sixth, you can just label it additional coverages. All right, so we'll start with the replacement cost. This is the very first step of a home insurance policy. This comes from, I called it insured. I asked them details about the house that they're buying. I go through the listing, tax records, inspection, if they have it at that point, and go through every detail about the house. So pretty much I know the percentage of crown molding in the house, how many fans there are, ceiling height, square footage of a deck, a porch. I know the house very thoroughly by the time I'm going to write the policy.
And these are really the roles of an underwriter, right? Or someone like yourself. I mean, I just want to share with everybody, I've worked with insurance for a long time. I've worked with people that have partnered with Village before and other people. And this is really key. It's kind of like the amount of time you would spend on a CMA, or, you could just kind of wing it, or you could, and the market's going to show you there. The challenge in her business or in insurance is, unfortunately, when you realize you don't have the right coverage is when you need it. And so it happened to me on a situation where, like, my agent just put down how much he thought the dock was worth at a lake house. A tree fell on it. He estimated $25,000. The dock was worth $38,000. Guess what I got paid out for a replacement? $25,000. So Abby has done so much consulting with me about being mindful to this. And these are other things. This may not seem sexy or exciting of what we do, but it is the real meat, the steak of the process of bringing value to your clients. So sorry to interject with my piece there, Abby, but it's so important what you're talking about here.
No, you're so dead on. A lot of agents will just be like, oh, that house is being bought for $450,000. Let's put that as the coverage amount. And so I'll get to that. But after I go through the replacement costs, working up the details about the house, that's how I arrive at the dwelling amount. And that is the total cost that it would take to rebuild the house after a total loss. So usually, especially in the Nashville market, that dwelling amount is honestly going to be lower than the purchase price or the loan amount. The $350,000 2-bed, 1-bath that you buy in East Nashville is really only going to cost $175,000 to rebuild. So I can't, as an insurance agent, insure for over the value it costs to rebuild. The reason being is that insurance is designed to make you whole. It's not designed to put you in a better situation than you were before the loss. So as an example, if that house was wiped out by a tornado, they could collect the full value for the insurance and sell the piece of land and end up better off than they were before the loss. And that's not the point of it. It's really about getting you back to whole. So that is why that you'll see a difference in the dwelling amount and the purchase price. The insurance is just for the structure. It's for the rebuild cost that it would take. And that sounds scary. I know that sounds scary, that you're like, oh, I don't have enough insurance to cover my loan. And that can be scary, but at the same time, you will be paid out that amount to rebuild your house. And if you do opt to sell the land, that makes up for a big difference. But for peace of mind and to help me sleep better at night, I recommend adding on extended dwelling coverage. So this is the second point. And you can do Different carriers will do like 25% or 50%. I tend towards 50%. So what that means is if you have 300,000 in dwelling amount coverage, and I add on the 50% extended dwelling coverage, then you have up to 450,000 of coverage to rebuild if you needed it. So you take the dwelling amount times the extended dwelling, brings you that 450,000. That helps me sleep better for a couple reasons. We all saw after the tornado that everyone is rebuilding at the same time. So building costs skyrocket. And that original dwelling amount is based on just an even building market. It's not accounting for everyone in downtown Nashville rebuilding at the same time. So that extra dwelling amount coverage, the extended dwelling amount coverage, gives you some buffer. It gives you some leeway if it ended up costing you more than that original reconstruction cost estimate. Hopefully that makes sense. And I am happy to answer questions at the end or via email anytime. Next thing is liability. I always recommend that my clients have at least 500,000 in liability on their home policies, and anywhere between 500,000 and $1 million is usually where I land. This is what kicks in to cover you during lawsuits. So example, it's 2023 and you can finally have housewarming parties again for your clients. They have, someone brings a friend of a friend. They're going down your staircase, the railing breaks, they fall, get injured, and sue you. This 500,000 in liability is what would kick in to protect you from the medical fees, the lawyer fees, and like the attorney fees. Another example, if you guys have kids and you have a trampoline, your friend's kid comes over and jumps on it, breaks their arm, parents sue you. It would kick in to protect you there. You guys have a fenced-in backyard and your dog is safely secured in the backyard. Something happens, it gets out of the gate, it runs to the front yard and attacks a runner. It's going to kick in to protect you in like a dog bite liability scenario. All right, deductibles. I am so curious. I wish that we were in person because I really want to know how many of y'all know what your home deductible is without looking. I
hear $1. $1.
Well, no, anyone. That's so scary. I really challenge y'all to go look at your policies and, oh, good job, Ann Nielsen. You know. So I do challenge y'all to go check on that because you don't want it to be 2 a.m. The tornadoes just come through and you don't know what your deductible is for your home insurance. It's like Teddy said, it's like a very bad moment to not know what you don't know. And so I recommend looking that up. I tend to recommend, just like Ann, $1,000 flat deductible for all perils. And the all perils part is important because some carriers will do 2 separate deductibles, one for wind and hail and another one for all other perils. And perils are like bad things that happen to your house. It's theft, hail, tornado, fire, pretty much anything that insurance protects you against. Those are perils. So in Middle Tennessee, wind and hail are the 2 most prevalent claims. That is like, I will take it to Las Vegas that you or your home buyers are going to have a roof claim because of wind or hail. So you want a reasonable wind and hail deductible. You don't want a crazy high one because that's most likely when you're going to cash in on your insurance. So the $1,000 all perils flat deductible is what I go for. Something to note is that there are some carriers that do a percentage-based deductible. State Farm is one of them. Farm Bureau typically does. So percentage-based deductibles can be very surprising. That means that if you have a 1% deductible, then your $300,000 dwelling amount times 1% equals a $3,000 deductible. That is surprisingly high. And I mean, talk about if we get up into, you know, a $750,000 home. It means you have like a $7,500 deductible when you might think that you have a $1,000 deductible. So definitely something to check on, having a flat deductible versus a percentage based. That's just not a fun surprise. And a lot of people ran into that. I keep referencing the tornado, but that was a huge part of my year. And a lot of people discovered their deductible was higher than they thought in March. All right, on to claims, the meat of insurance. It's what we're here for. It's what you guys rely on me and my colleagues for. So this one is the replacement cost versus actual cash value point. Like I mentioned, wind and hail, most likely to have a claim, biggest percentage of what my claims are. So that means that roofs matter a whole lot and how your roofs are covered. There are two different options. There's the replacement cost and there's actual cash value. You want replacement cost like so badly. Replacement cost means that if you have an 8-year-old roof and a windstorm knocks it out next week, you're going to be paid for a brand new roof. So they don't take into account depreciation at all. If you have actual cash value on your policy for your roof, that means that you're going to be paid out for an 8-year-old roof. They're going to take into account depreciation. So you are responsible for the difference between what it actually costs to replace your roof and that depreciated amount that you were paid for. Not a fun surprise. And it sounds like I'm totally digging on State Farm, but they are most likely to do actual cash value. So check that out. I have a note here to make sure to note that that is like, should be number one takeaway is go and check your policy for replacement cost on your roof versus actual cash value. All right, last main point, additional coverages. The, again, reiterate, insurance policies aren't created equal. These don't come standard on every policy. Over the years, they're what I gravitate towards adding on policies the most because I see their importance. There are countless other endorsements that I could go on about, but these are the three main ones that I really want to touch on. The first one is sinkhole. I took a riveting continuing education course recently on sinkhole insurance, and it turned out that Middle Tennessee, the most common underlying rock is limestone, extremely sedimentary rock, which means that we live in a sinkhole prone area. This doesn't come on every policy. You want to make sure that you have sinkhole added on. Let's see, the next one is a newer coverage. It's called underground utility line coverage or service line. It goes by those two names. So what this is it covers the distance from the street to your house. That area was typically no man's land in insurance because it wasn't covered by insurance and it wasn't covered by the city, but it was your land, so you were responsible for it. So insurance companies realized that there was a gap in coverage there and they rolled out underground utility line coverage. So that means that, example, you have a tree in your front yard and the roots grow into the lines, your water lines that are running from the street to the house. They damage those lines, it creates a mess in your whole front yard. This coverage would kick in to cover like the excavation of the pipes, the repair, the replacement, and getting your yard back to how it was before the prior loss. So newer coverage, you probably don't have it on your policy, honestly, if you've had your policy for more than a year or two. It kind of rolled out and got very prevalent in the last year. So definitely something to call and ask about adding. I always make sure to tell my clients that when they're setting up their utilities for their new house, Metro Water is going to ask, hey, do you want to add on like this sewer line coverage for $7 or $8 a month? And I tell them, say no, because I've included in your insurance policy. And sorry, I was reading the question. I'll come back to it, Van. Yeah, it's included in your home insurance policy. So I don't want you paying for something twice. So you can tell the utility line company, no, I don't need that coverage. I have it on my home insurance. Only if you have it on your home insurance. Last additional coverage is sewer and drain. This is when the sewer backs up through your sinks, toilets, and drains. It is as gross as it sounds. It's a bad day for everyone involved. And most likely this is going to affect your bathrooms. That's where you have the most drains to the sewer. So I like to make sure that they have enough of that coverage to handle replacing the tiling, flooring, subflooring, and handling like ServPro coming in and doing the drying out of drywall or anything that affects it. So those are like the pillars of a great insurance policy, in my opinion. Let's see. So takeaways: 1, find an agent that you trust, that you love, and that you like working with, because the better they are, the better it reflects on you because you told them about this person.
Well, and beyond that, and I'll add to that, you might like them, but you need to make sure they're thorough. Like, so I've just done this a long time now, and I only had one company last year for 1 year because they didn't call me at the year mark to audit my policies. And the person before that just waited till after renewals to talk to me about revisions. Well, after renewals, they already got paid. And so that's a terrible time. You want to be making coverage changes before renewals. And, insurance is important. Your agent should be calling you at least annually to just say at renewals, hey, has anything changed in your life? Do we need to be considering things like this? Have you had any issues? Like, this is an expensive and part of adulting that, and if you own rental property, I mean, that's where Abby really got me into the weeds of creating separate umbrella policies for the LLCs. And I know, Loy, you were a part of this endeavor, was how to protect myself in owning rental property, utilizing the LLC and how to manage incomes and all that, and then liability protection. So, again, sorry, Abby, I keep jumping in, but they're just such key points you're making here that I think it's so valuable we share.
No, I love it. And yeah, you bet that when you came to me and said, hey, my old agent didn't check in with me at renewals, I immediately go to my calendar, and 2 months before your policies renew, I have an alert that says, hey, Abby, make sure you check in with Teddy. This is important to him, and let's do this. So finding someone that cares, that listens and cares and is thorough. Just to recap, go and check your own policies. Consider it like a test for your clients. Go and check that you have extended dwelling. Go and check that you have high liability, that you have a deductible that you're comfortable with. Go check that your roof is replacement cost versus actual cash value. And go check for some of those additional coverages. That's all I have. Loy.
It's great. Sarah Thomas had, Sarah, what was your question about what type of coverage?
The one that she was talking about with like the service lines to the street that people were saying cost them $10K if they didn't have.
Yeah.
What's that called?
Diana. Yeah, that is called underground utility line coverage, or some carriers call it service line coverage. So typically you'll pick a limit for that, and I'll usually do like 25,000. Diana, I'm so sorry that you had that happen to you. Go get it added. Oh, wait. Oh, no, you did have it covered. Good job.
Ann Nelson, unfortunately, had that experience, and I know
I'm so sorry.
as well. And I would recommend, don't buy the insurance through the insurance company rather than the gas company or the water company to replace your line. My experience is that coverage can be kind of a mixed bag.
Yeah.
Any other questions, post them here. And a couple things I want to make. Insuring pit bulls and dangerous breeds, is that changing, and how is that? How do we deal with that? How do owners deal with that?
So there are a couple carriers that I work with where you can do animal exclusions, which means that they will write a policy, but if your dog does injure anyone, it is not covered. So that's, if you're comfortable with that risk, you can take it on. I am so sad for the insurance world that they can't understand that it's a case-by-case situation. It's not a breed situation. But I do have carriers that will accept pit bulls and some of the other dangerous breeds. But there are also surplus line policies that you can get. Aegis, AEGIS, is an insurance company that will write liability for the bully breeds, whatever that means.
Yeah, terriers. Everybody's got a terrier or a mutt, according to my insurance company.
Yeah.
Also, make sure you get your pets spayed, neuter, and let everyone know your all the contents of your car. My car was stolen one time from the dealership when I left it for service, ironically. All the contents of your car are not covered under your car insurance. Raise your hand for all those that are hiding behind their screens. You didn't know that. The contents of your car are not covered under your car insurance, like everything. Like your last week's outfit that you just bought, off the runway in the trunk, your radar detector from 1986, all that stuff in your glove box, the rollie that nobody wears anymore, whatever you are, those people, none of it's covered. So that is all under a renter's or homeowner insurance policy, nothing attached to the car, or only things attached to the car. So I use that as an extra layer for renters as well, to make sure they get a renter's insurance policy and that they list you as a, what do you call that, Abby?
Additional interest.
There you go. There you go. There you go. Any other questions before we part? Here's what I commit. I'm going to, in 2021, I'm going to do an extended class. I'm going to separate us. And Abby, we're going to put you on for a full hour. And Loy, we're going to give you some more time to do some of your show, because it is really important. I'm so glad for those that came on here. Please give a hand for Abby and Loy. And I wanted to add to Loy's point, when you go to closing, it is time. I mean, I've worked with Rudy Title a long time, but, Sarah, I see you on here, is that it is time to take an assertive role. I don't love the word control, but you want to walk in and you want to be an assistant, a good supporter to the team there. So, if the receptionist or the front desk person there is assisting other people or on the phone, and again, this is COVID related if you can be in the building, but prepare your people of what they're going to walk into, what to experience, what to bring. So I have emails that I send alerting to those things, like bring your checkbook, bring your driver's license. When you come in, here's what to expect. And sit, if you are participating, do sit at the head of the table, offer to help get them coffee or drinks if you can at that location. And have a copy of your paperwork, and don't sit there and text the whole time. So your title company is a real partner with you, as with your lender and with like Abby as your insurance person or whoever that may be. You're a team that's putting this miracle together. That consummation is such a big stressful day. And I mean, Abby said, I know what I realized in listening to Loy, I didn't look at my Alter CD. I said, at that point, you're just trying to hope you're wearing underwear and that your shit's not damaged in the back of the truck, right? Like, so the rabbit's in the car and, you're worried about moving. And so your realtor and your team partners hopefully have checked all those things. And this is a chance for you to be that quarterback and bring those resources. So any other parting thoughts or comments? This is the longest class.
One other thing.
Yeah.
Teddy, real quick, I emailed you my presentation, but I also put it in the notes on the side. So if you want to grab my presentation, just grab it before you close out of this Zoom meeting today.
Excellent. You just click on that in the chat. It will download for you.
Mm-hmm.
And I apologize that that I had some snafus on the links and that we went a little over for everyone that stuck in. But I've already had people commenting. They were so thankful it's recorded that they couldn't have a chance to either stay on or watch it. And so we do get a lot of people watching the recording. So so note that your information goes much broader than just who's on here live. And again, thank you so much. Happy holidays to you both. Love you. Appreciate you. Loy, are you in the East office these days? Where are you?
Well, I'm actually in my kitchen right now, but I'm normally in the East office. This is my kitchen.
It's beautiful. Yeah.
But I do, right over behind my head here, I've got a picture of the Rudy Title 21st office right there.
Well, there you go. We don't want you to go far from home.
Yeah, I can't get too far.
All right. Good deal. Be well, you all. Do audit your insurance. This is the time of year to do it. And do a video tour of your home.
Yes.
Open every drawer. Go through your closet slowly. If there ever was a tragedy, that is the tool you're going to want to have. And I've been selling that tool for 6 years. I still don't have one in my house. I will do it this holiday season. All right, y'all. Take care.
Thanks.
Bye-bye. Appreciate you.